Hello traders, and welcome to my second video on chart patterns. In our first video we went over symmetrical triangles as continuation patterns of the trend, and in today's video we will be looking at the opposite, reversal patterns, specifically the double bottom and the double top. We're going to be going over what is a double bottom and double top for those who don't know. We'll be talking about why they form, psychology wise, and also the volume that fits the double top and the double bottom. After that, we're going to look at two different kinds of examples, and we're going to finish with looking at how exactly we would trade them for profit targets and for stop losses. So first, let's talk about what these are and how to identify them. A double bottom occurs after a downtrend that forms a support point. Then price breaks higher, fails to break any higher than this level right here, and then price comes back down to 2, and then we see price picks up a lot of demand and breaks through the neckline. So why does this happen? What is the order flow reason behind this, and what is the psychology reason behind this too? Well, there are two reasons why we can see point 2 becoming support. The first reason is that when we see point 1 becoming support, many traders are going to put their buy orders at around the 1 level, which would also form the 2 level, because if price goes here, but then we see that a lot of buy orders are here, it's going to be very hard for price to break this support level, meaning that price is probably going to go upward. The second reason why we would see 2 to become support is if many traders saw that 1 acted as powerful support with high volume, they would see that 2 would probably be another point where demand will begin to outpace supply. And then this point, we could see that many buyers piling into the market because they think that the support will hold, and then as that happens, more and more traders get into it, and then it gets into a fear of missing out, which would propel the price much higher. The volume behind this is what you would typically see at points 1 and 2 is very high volume, because as you would know, whenever you see very high volume at a point, typically that point could become a reversal if it's been a sustained trend. So when we see a sustained trend and then we see volumes very high, typically that's going to be a reversal. We see that right here. And this point typically has low volume, and then this point typically has low volume as well. And then this point typically has very, very high volume as price breaks the neckline right here. If you don't see high volume when price is breaking that neckline, then the double top or double bottom is a bit less likely to occur, because you need volume to propel the price much higher. And why is it that volume propels prices higher and lower? What's the reason behind that? Volume is the fuel of prices, and the more traders who enter into a market at a bottom as price is going up, the more propulsion it has to go much higher. And if this point has a lot of volume and then has a lot of sustained volume, then demand for the asset's very high. And if demand for the asset's very high at around these levels, it'll typically be, that same demand will typically be very high among these levels, and then price will continue to go upward until supply begins to outpace demand, and then we would see price go down. So that's the reason why volume is so important looking at any chart pattern. You need to see that demand is high enough or supply is high enough to outpace demand in this example. Okay, so now we've gone over the psychology of the market, why these form, and what exactly these patterns are. Now let's talk about two examples of what they look like. So our first example is the 1 hour on Ethereum that recently happened a few days ago. This might look like a bit of a sloppy double top, but it is still a double top. What we can see here is if we just draw this, if we draw this line right here, a horizontal line at the 347, we can see that price did touch this a few times, but just imagine this as 1 point of the left side of the double top. And then on the right side of the double top, we can see that price broke it, but still made the double top. And just like you should see, just like what I just said, we saw very high volume at point 2. This is our point 2. Think of that as our double top. And very high volume at around 0.1. And you can see the very high volume here, and then also some volume here. We saw falling volume here, just as we expected, and we saw increased volume to the downside, as you can see right here, with very strong candles. So what would we do with this pattern if we had seen this in real time? Well, if we had seen this in real time and we were looking to short the market, how would we enter? There are two ways that you can enter this market, and both ways require one to wait for the double top to be confirmed. What you don't want to do is just to assume there's a double top and then just sell immediately. You need to wait for this pattern to build itself out. So if you get to this part here and you're looking to enter a short in the market and you think this is going to be a double top, you could short here, stop loss here, and then target 2 times the range of this right here. And we're going to go into that pretty soon. That's one way you can enter this market. The second way that you can enter this market is to short once you see a confident breakout of the neckline. Again, we can see the necklines here. This point right here is our neckline. And when price breaks out beneath it, which happens right here on fantastic bearish volume, right here you can see it, this would be another good spot to short and then stop loss around the midsection of the formation of the double top. So those are the two different ways that you can trade these double tops and double bottoms, either by entering really aggressively at a support or resistance level, or waiting for a price breakout and having a high probability of success, but less reward, or high reward but lower probability of success. It's all in how you want to trade the market. So that 2 times the range that I was talking about before, the way that double tops and double bottoms operate is typically what you see is the distance from the neckline to the top, or the distance from the neckline to the bottom line. You typically want to have that distance, and then you want to see that distance plus this distance right here. That might not make sense. I might not have just explained that in the best way, but typically what you see is this. I'm going to draw a box to show it. So if we see that this box right here is the range from our top line to our neckline, what you would see is typically this same exact magnitude. So like, let's say this was like 30, you would see 30 right below the neckline down to like here. And these should have the same magnitude before we get a retracement or a reversal in the opposite direction. So if we just do a quick calculation to just make sure that this is correct, what we would see is, let's just do 320 as our neckline, and we have our top line at 347. So that would be 27. So what we would expect is to see the market drop 27 from the neckline. So all we would do is 320 minus 27, my calculator right here, and that would be 293. And we can see the price went down to 288. So fairly accurate indicator of how far down we would get the next support level. And this is a great way to get a good take profit level if you are trading it. Just put your take profit at one magnitude of the range below the neckline, and stop loss if you're being aggressive right above the top line. And then if you are being more conservative in selling or shorting here, then it would be a stop loss around the midpoint here. So that would be the double top. Now let's look at the double bottom on TradingView. So right here we have a beautiful double bottom right here. And this is confirmed again by very high volume right here. You can see high volume here and high volume around here too. So what do we see here? We see that price was in a consolidation but slightly downtrend period. Goes down to here. Breaks higher but fails, and then comes back down to the same support level. Now if we were traders and we were and it was August 19th, then we would see that this point would be a point of entry if we want to enter at support and put our stop loss right below here at around 270. And if we wanted to find, again, an easy take profit, all we could do is say, okay, this is the neckline right here for our period, and that looks to be around 308.5, so I'm going to type that in just for a simple take profit point. And then we have our bottom line at around 280. So 308.5 minus 280 is 28.5. Now we would add that to the neckline, so that's our 308.5 plus 28.5, and that would be 337. And if we look here and put our take profit at 337 and our stop loss right below here for a confident, nice risk reward, we would see that we would have been hit right here with nice upper tails, and then we could get into the market if we wanted to, again, around here. And this would be a fantastic trade to take. So that's going to be it for our double top and our double bottom reversal patterns. What you need to remember is one, the volume, the high volume at 1 and 2, here and here, and you need to know, you need to label your neckline, you need to label your bottom line or your top line for resistance and support. And then also you need to set your take profit points to be just top line minus neckline, same magnitude, will be continued from the neckline downward. And if you have any questions on any of the mathematics behind this, the math isn't that complicated, but maybe I didn't explain the math part of it fantastically. If you don't understand that, then I can explain to you guys in the comments if you want to leave a question of how exactly to set your take profit points and your stop losses as well. Bottom line is that double tops and double bottoms are fantastic, reliable chart patterns for reversals. And if you can see high enough volume, then these will typically be fantastic points to enter the market. One last cautionary note before I end this video is one way to identify a fake double bottom or a fake double top is if you see price go up and then go down a little bit and then go up immediately back to that same resistance point, that is not a double top. What that means typically is that price is going to continue to the upside. Why do I say that? I say that because if price has that much demand for the asset, if there's that much demand for the asset that it barely retraces and then it immediately goes back up to that resistance level, demand is probably so high, causing the market to probably break that resistance. What you want to see for a double top is price to make a resistance level and then come down and have a good amount of time before it makes another top. So a good example of that would be here. We can see that on the 4 hour, the price went up and then went back down with a separation of about 4 days, which period wise would be like 16, 17 periods. But if you saw this happening in 5 or 6 periods, that's really not a good sign. That would mean that probably price would continue to go lower. So just that cautionary note, all that you need to know is you need to see a good amount of time and space for your double top or double bottom to actually form. So that's going to be it for this video. If you have any questions, like I said before, just leave them in the comment section below. And if you have any other kinds of chart patterns that you want me to go in depth into, then I am happy to do so. Thanks for watching.